Welcome to the Deep Dive from Finbot Insights.
Hello.
Our goal here is pretty straightforward. We take complex research, complex analysis, and really distill it down into the knowledge you need.
Especially if you're focused on building long-term wealth, maybe for future income.
Exactly. And today, we're tackling a really fundamental question. It's something every investor thinks about. How many stocks do you actually need for, adequate diversification?
Particularly thinking about that long-term horizon, measured in decades.
Right. So for this deep dive, we're using a really interesting article from NDVR's journal. It's called How Many Stocks Should You Own?
Yes, by Chen and Roni Israelov.
And our mission today is basically to unpack their analysis. They challenge some pretty common assumptions.
They certainly do.
And we want to understand what their findings really mean for your investment strategy, especially over the long run.
Okay, so portfolio diversification, it's obviously central to managing risk. And I think many investors, they hear this guideline, this sort of rule of thumb, that holding maybe 20 to 30 stocks is enough.
Yeah, that's the number you always hear.
Right. Enough to get most of the diversification benefits, reduce your risk significantly compared to just holding a few stocks.
Some sources might even say, 60 or 80? But 20, 30 is the common one.
It is. And that it feels sort of intuitive, doesn't it?
It does. The idea that, once you have a couple dozen companies, adding one more isn't going to move the needle much on risk.
And this conventional wisdom, it often comes from academic studies using, a simplified theoretical market model.
Okay, explain that model a bit. How does it work?
Well, it basically provides a framework, a theoretical one, for estimating how portfolio volatility, the risk goes down as you add more stocks.
That makes assumptions.
Yes, it relies on assumed parameters, things like assuming all stocks have sort of uniform statistical properties, a certain market volatility, say 15%, and a specific stock volatility, maybe 45%.
And then it plots this out, like in figure 1 of the paper we're looking at.
Exactly. Figure 1 plots that estimated portfolio volatility against the number of stocks, and you see what you'd expect initially.
Red volatility drops really fast with the first few stocks added.
Sharply, yes, but then the curve flattens out quite a bit.
And the reduction in volatility, it really slows down once you get past that, 20 or 30 stock mark.
Correct. And that visual, that diminishing return on volatility reduction, that's really the basis for the conventional wisdom.
So the argument is, since adding more stocks gives you less and less volatility reduction after 30, a portfolio of 20, 30 stocks is similar enough, risk-wise, to a fully diversified one, at least according to that model.
Within the confines of that simplified model, yes, that's the conclusion often drawn.
But this is where the authors, Chen and Israelov, they really push back hard.
They do. They look at that conclusion and flat out say 20, 30 stocks is too low by a lot.
Okay, strong words. Why? Why do they think that convergence in volatility is misleading?
Well, their main point is that it's misleading from the perspective of a long-term investor, someone focused on terminal wealth, what you end up with after decades.
Right, not just next year's volatility.
Exactly. They argue that just relying on a simplified sort of single period volatility model, it completely overlooks the cumulative impact of risk and return over many, many years.
So while the average annual volatility might look similar,
the distribution of potential outcomes, the range of how things could turn out over 25 years is actually far from converged with just 20 or 30 stocks.
Okay, so if that standard theoretical model isn't cutting it for the long-term view, what do they do instead? How do they analyze this to get to such a different conclusion?
Their approach is quite different. They use simulations, a simulation-based methodology.
Okay. Computer simulation.
Yes, which lets them explore the whole range of potential investment outcomes over a long period, like decades, instead of just a static calculation.
Makes sense.
Yeah.
So how did they set up these simulations? What period are we talking about?
They simulated portfolios over a 25-year period, specifically December 31st, 1994, right through to December 31st, 2019.
A decent chunk of time. And how did they build these portfolios in the simulation?
So for each run, and they did thousands of these runs, they randomly selected AIR stocks, M being the portfolio size, starting from 10 stocks or more.
And where did they pick from?
From the top 1,000 companies by market cap that were available back at the start date, December 94.
Okay, random selections from a large pool. And then, over the 25 years, how are these portfolios managed? Just buy and hold?
No, not just buy and hold. They used a a more realistic strategy. The portfolios were rebalanced every month back to equal weights.
Okay.
And if a stock got delisted, say it went bust or got acquired,
It happens.
it does, it was replaced by a new, randomly selected stock from the eligible list at the next rebalancing point, and dividends were reinvested too.
So it simulates actually managing a portfolio of a fixed size, dealing with turnover and reinvestment.
Precisely. It's trying to mimic that experience.
That definitely sounds like a much richer, more dynamic approach than the simple model. What were they tracking? What key statistics did they look at for each portfolio size?
They focused on 3 critical stats to really understand the variability, the range of outcomes.
Okay.
First, something called the terminal wealth multiple, or TWM.
TWM, what's that?
It's simply how much wealth you accumulated at the end of the 25 years for every dollar you started with.
So your total growth factor.
Yep.
Very relevant if you're building capital for income later.
Hugely relevant. Second, they didn't just look at average volatility, they recorded the distribution of the annualized volatilities that each simulated portfolio actually experienced over the whole 25 years.
So the range of riskiness observed.
Exactly. And third, similarly, they captured the distribution of the annualized returns achieved by these portfolios over that same 25-year period.
So the range of growth rates achieved.
Right. The whole point was to understand the spread, the good outcomes, the bad, the average for different portfolio sizes, not just assuming everyone gets the average.
Understanding that distribution, not just the average, that feels critical, especially for long-term goals where, avoiding those really bad downside surprises is paramount.
Absolutely.
So let's get into the results, starting with that terminal wealth multiple, the TWM. As you said, for income investors, this is key. It's the capital base you have to generate income.
It really is. And Figure 2 in their paper shows these TWM results. But crucially, it doesn't just show the average TWM.
Because the average doesn't tell you the risk of a poor outcome.
Exactly. So instead, they plot the 10th and 25th percentiles of TWM across the different portfolio sizes, 10 stocks, 25, 50, up to 500.
So this shows you what happened to the unlucky portfolios. The bottom 10% or bottom 25% for each size?
Precisely, the less fortunate outcomes.
And looking at that Figure 2, wow. The difference in those lower percentile outcomes between, say, a 10-stock portfolio and a 500-stock portfolio, it looks massive. Much different than that flat volatility curve in Figure 1.
It's a stark difference. The figure shows, for example, an unlucky 10-stock portfolio, one that landed in the bottom 10% of outcomes. It only achieved a TWM of about 9 times the initial investment over 25 years.
Okay, 9x.
Now, contrast that with an unlucky 500-stock portfolio, also at that 10th percentile. It achieved a TWM of around 18x.
18x versus 9x. It's double the terminal wealth.
Roughly double, yes. Just from having much broader diversification, even in that unlucky scenario.
So same level of unluckiness, let's say, being in the bottom 10%, but the more diversified portfolio ends up with twice the capital. That's not a minor difference. That could totally change whether a retirement income plan works or not.
Fundamentally change it.
And Figure 2 definitely does not show TWM flattening out around 20 or 30 stocks, like the volatility model suggested.
Not at all. The authors point out that the slope of that TWM curve, especially for the lower percentiles, stays pretty steep until you get out to around, say, 250 stocks.
So adding stocks well beyond 20 or 30 continues to significantly improve the worst-case potential outcomes for your long-term wealth.
That's the finding. It meaningfully improves the lower bounds. They actually quantify the risk of a shortfall. For a 25-stock portfolio, there was a 1 in 10 chance, that 10th percentile, of ending up with less than a 12x TWM.
Okay, 12x.
Now remember, the average TWM across all simulations was about 19x. So that 12x outcome for the unlucky 25-stock portfolio is a 36% shortfall from the average expected wealth.
Ouch. A 36% deficit in your nest egg just from having potentially 2 through stocks. That's a huge penalty.
It's substantial.
How does that compare to a portfolio with more holdings, like the 250 stock example? What was the 10th percentile TWM there?
For the 250 stock portfolio, the 10th percentile TWM was much better, around 17x.
Okay, 17x versus the 19x average.
Right. So that represents only about a 10% shortfall from the average outcome.
So the difference is massive. The unlucky 25 stock investor faces a potential 36% shortfall, while the unlucky 250 stock investor faces only a 10% shortfall.
That's the comparison. And it really highlights how important diversification is for protecting that final pot of money, that terminal wealth, which, as we keep saying, is crucial if you need it to generate reliable income later on.
That TWM analysis over 25 years is incredibly powerful. It really blows up the idea that 20, 30 stocks is good enough diversification.
Yeah.
So, what are the underlying reasons the authors give for this huge difference between the simple model and their simulation results?
They point to three main reasons. The first has to do with how that simple model's focus on average annual volatility in a static way can be really misleading over a long haul.
Okay.
So yes, diversification quickly reduces the average idiosyncratic risk. That's the risk tied to individual companies, not the whole market.
Right.
But the remaining specific company risk in a smaller portfolio, even if it's a smaller percentage on average each year, it compounds over 25 years.
So even a little bit of specific risk left over year after year adds up.
It can add up dramatically. An unlucky draw of stocks within that smaller portfolio can still drastically underperform over the long term. Just looking at a slightly lower average annual volatility number doesn't capture that long-term danger from poor individual stock outcomes. Compounding is powerful.
It works on returns, but it also amplifies sustained underperformance if you picked a few duds in a concentrated portfolio.
Precisely. The second reason they highlight is about the distribution of outcomes, not just the average risk level.
Right, and you mentioned Figure 3 illustrates this, showing the spread of portfolio volatilities.
Correct. Figure 3 shows the distribution, the spread, of the actual annualized volatilities the simulated portfolios experienced. And while the average volatility might converge slowly as you add stocks,
The range is different.
yes, the range or spread of potential volatility outcomes for smaller portfolios, like just 25 stocks, is much, much wider than it is for portfolios holding 100, 200, or 500 stocks.
So with a smaller portfolio, you have a much higher chance that the actual volatility you experience over 25 years is significantly different from that theoretical average. Could be way higher, could even be lower, but it's less predictable.
Exactly. It increases the risk of an atypical outcome for your specific portfolio. So to reduce the chance that your particular random selection of stocks turns out to be unusually volatile over the long run,
You need more stocks.
you need more stocks. More holdings tighten that distribution of possible realized volatilities. It makes your portfolio's risk profile more reliably close to the average.
Okay, that makes sense. What's the third reason?
The third reason is something the simple model completely ignores: the fact that different stocks can and do have different expected returns.
But isn't the assumption often made, especially in simpler models, that over the long run, maybe all stocks offer roughly the same expected return?
That is an assumption sometimes made for simplicity, sure, but it doesn't really reflect the reality of realized returns over any specific long period. We can't know beforehand which stocks will be the winners.
Right.
But after the fact, looking back over 25 years, there's always a wide distribution of the actual average returns different stocks delivered. The simulation captures the effect of randomly picking from that real-world distribution.
Okay. So a small portfolio, just by random chance, might end up loaded with stocks that happen to deliver lower returns over that specific 25-year simulation period.
Precisely. And Figure 4 in the paper shows this clearly. It plots the distribution of the portfolio's average realized annual returns for the different portfolio sizes.
And what does it show?
It shows that the distribution, the spread of those average realized returns, is much wider for a portfolio of, say, 25 stocks compared to portfolios of 100, 200, or 500 stocks.
A wider spread means a higher chance your specific portfolio lands on the lower end of the return spectrum, just purely because of the luck of the draw with those 25 stocks.
That's the crucial insight. A smaller portfolio faces a higher risk of being unlucky just in terms of the average returns its stocks actually deliver over a long period.
And unlike short-term volatility swings, even small differences in the average realized return rate,
when compounded over 25 years, have a massive impact on your final wealth. Huge. Regardless of whether the simple volatility numbers looked similar.
wow. So minimizing that risk of just happening to pick a basket of persistently lower returning stocks, you do that through broader diversification.
Exactly. And that's absolutely critical for maximizing the terminal wealth you need for generating income later.
That really ties it all together. The compounding effect of even slightly lower returns over decades just swamps any perceived benefit from hitting a certain volatility level with only a few dozen stocks.
Okay, so putting all this simulation evidence together, the TWM results, the volatility distribution, the return distribution, what's the author's final word, their conclusion on how many stocks are needed.
Well, based on this pretty rigorous simulation work, they include first that there isn't one single magic number for perfect diversification in theory. From a pure diversification standpoint, more is always better than fewer.
Okay, no magic number. But their findings strongly indicate that the conventional wisdom, that 20 to 30 stock range, is demonstrably not enough. It's insufficient if you're measuring diversification by long-term outcomes, like protecting your terminal wealth.
So what's their practical advice then? For long-term investors who want to avoid the risks their simulation uncovered.
Their recommendation is pretty clear. They suggest long-term investors should aim to hold at least 200 stocks.
At least 200. That's a big jump from 2030.
It is. But according to their simulations, that level of diversification is what's needed to more reliably capture the market's full potential over time, and crucially, to significantly reduce the risk of those really large shortfalls in terminal wealth that can happen with less diversified portfolios.
Now, of course, we should acknowledge, and I think they do too, that practical things beyond just pure diversification theory might play a role.
Absolutely. Things like, your ability or desire to research hundreds of individual companies or potential trading costs, those might influence the practical number of stocks you choose to hold.
Sure, real-world constraints exist.
They do. The authors are primarily focused on the diversification benefit itself, but their core finding is a really powerful counterargument to that simplified view. It highlights a significant long-term risk that investors might be taking if they believe just a few dozen stocks gives them enough diversification.
This deep dive, it really provides a critical perspective, I think, especially for anyone building wealth for the future, and particularly those of you focused on generating income down the road.
It really shows that getting robust, reliable, long-term results seems to require thinking beyond just simple average volatility numbers.
And embracing much broader diversification than maybe we've been led to believe is necessary.
Yeah, the simulation approach really drives home how the luck factor, the luck of picking specific stocks, becomes much less important to your overall outcome as you add more holdings.
Leading to a more predictable path and potentially a higher one for your long-term wealth.
That's the idea.
So a final thought for you, our listener, to consider as you look at your own portfolio and future plans. Just reflect on that subtle but really significant role that the luck of stock selection can play, especially in concentrated portfolios over the long term.
And how increasing diversification, maybe well beyond those conventional levels, even up towards that 200 mark or more, might be a really critical factor in securing your financial future and your potential for income.
The evidence here suggests it's definitely worth thinking about. It offers a compelling quantitative reason to maybe reconsider some long-held assumptions about diversification.
Indeed.
This has been another deep dive for Finbot Insights. We really hope this discussion gives you some valuable insights for your own investment planning.
Hope it was useful.
And please remember to click like on this video if you found it helpful and subscribe to the Finbot Insights channel. We'll have more in-depth analysis based on research and data coming your way.